A ULIP is one of those products most people buy with a general idea of what it does. Insurance plus investment, both in one plan. But information like which fund your money is actually in or how the charges work over the time are details most people may not be fully aware of. And with a product you are committing to for 10 to 20 years, these details really matter. So picking the wrong plan is not just an inconvenience, it is a rupees 5 to 10 lakh decision made without the full picture. So today, we are answering the question that should come before any ULIP purchase. How do you choose the right ULIP plan in India? In the next 7 to 8 minutes, you will get a clear 5-point framework to evaluate any plan before you buy it. We are going to unpack the 5 things you need to check while choosing a ULIP plan in India in 2026. Your primary goal, whether insurance or wealth creation, the fund options available across equity, debt and balanced, all charges including premium, allocation and fund management fees. Whether the lock-in period matches your investment horizon and the insurer's claim settlement ratio. Before we get into the framework, a 60-second recap for anyone new to this. A ULIP or unit-linked insurance plan is a financial product that does 2 things at once. One part of a premium goes towards life insurance cover. The other part is invested in market-linked funds. You choose which funds, and you can switch between them during the policy period. That is basic structure. Insurance on one side, investment on the other. Both are running on the same premium. Now, how you select a ULIP plan for wealth creation in India comes down to how well you match the product to your specific goals. That is what the framework is for. One important note before you continue. ULIP is designed for long-term goals. The minimum lock-in period as mandated by IRDAI regulations is 5 years. But the product generally works best when you commit to 10 years or more. If your goal is shorter than that, a ULIP may not be the right fit. Here are the 5 things you need to check before buying any ULIP. Take a screenshot of this so that you can refer to it afterwards. First, your primary goal. Second, fund options available. Third, all charges. Fourth, lock-in versus your financial horizon. Fifth, insurer's claim settlement ratio. This framework is adapted from IRDAI's policyholder disclosure guidelines, which require all ULIP insurers to disclose fund performance, charges, and locking terms in a standardized format. Point 1. Your primary goal, insurance or wealth? Start here, not with the product, with your goal. Are you trying to build a retirement corpus? Fund your child's education in 15 years? Build long-term wealth? Your answer changes everything about which ULIP you should be looking at. A child ULIP, for example, is specifically structured so that if you pass away mid-policy, future premiums are waived and the policy continues for your child. A retirement ULIP builds up your savings over time, then converts them into a regular income and annuity when you retire. ULIP is the right product when your goal is long-term wealth creation with life cover built in. But if your primary need is making sure your family receives the highest possible sum assured, say 1 crore or more, in case something happens to you, that is what a term plan is designed for. A term plan gives your family a larger cover amount for a lower premium because the entire premium goes toward protection and nothing else. Know your goal before you pick your product. Point 2. Fund options available. Equity, debt or balanced. Once your goal is clear, look at the fund menu. Every ULIP gives you a choice of fund types. Equity funds invest primarily in stocks and carry higher risk with higher growth potential. Debt funds invest in bonds and fixed income instruments. More stable, slower growth. Balanced or hybrid funds sit in between. Your choice depends on 2 things: your risk appetite and where you are in life. Say you're 32 years old, your goal is retirement at 60 and your risk tolerance is moderate to high. You have roughly 28 years. Starting with more money in equity funds gives your savings room to grow over time. Markets go up and down, but over 20 plus years, equity has historically delivered strong growth. As you get closer to retirement, say around 55, you gradually move more of your money into debt funds. Debt funds are more stable. The idea is simple. You spend years building your savings and at this stage, you want to protect them more than you want to grow them. This is actually what life stage ULIPs automate for you. They adjust the equity to debt ratio as you age. Worth considering if you do not want to manage this manually. The key question to ask: how many free fund switches does the plan offer per year? Some plans offer 4 and some offer unlimited. Your allocation should not stay static for 20 years. Point 3. All charges. Every single one. This is the section most ULIP buyers skip. Do not skip it. ULIPs carry several charges and they compound over time. Here is what you need to know about each one. Premium allocation charge. Deducted from your premium before it is invested. This means if you pay rupees 1 lakh and the allocation charge is 5%, only rupees 95,000 actually goes into your fund. Some plans recover this at maturity. Ask specifically whether your plan does. Fund management charge. Deducted daily as a percentage of your fund value before the unit price is calculated. This is an ongoing cost that continues throughout the policy. Compare this number across plans. Mortality charge. The cost of your life cover, deducted monthly and varies by age, gender, and sum assured. It increases as you grow older. Policy administration charge. A monthly administrative fee, usually deducted from units. Surrender or discontinuance charge. If you stop paying premiums during the lock-in period, this applies. Your fund is moved to a discontinued policy fund. The proceeds may be moved into a discontinued policy fund as per applicable IRDAI regulations and policy terms. Two plans with similar headline returns can have very different outcomes depending on their charge structures. Run the number across 15 to 20 years before you decide. That is how to evaluate a ULIP plan before buying in India. Point 4. Lock-in period versus your financial horizon. IRDAI regulations mandate a minimum 5-year lock-in for all ULIPs sold in India. As confirmed in the Insurance Act, during this period you cannot withdraw your fund value. If you stop premiums and surrender before the 5 years, discontinuance charges apply. But the lock-in is not the real question. The real question is, does your financial horizon match the product's optimal holding period? If you need the money in 6 years, the 5-year lock-in technically allows withdrawal. But a ULIP with market-linked returns has not had enough time to work through short-term volatility. You may exit at a low point. A ULIP genuinely works well when your horizon is 10 years or more. The equity component needs that runway to deliver meaningful compounding. Also, check what type of ULIP you are buying in terms of premium payment. A single premium ULIP requires one lump sum. A regular premium ULIP requires payment throughout the tenure. A limited premium ULIP lets you finish paying in a shorter window, say 5 or 10 years, while coverage continues. Knowing which type fits your cash flow before you commit is how you avoid the most common ULIP mistake. People treat a regular premium product like one-time investment. It is not. Point 5. Insurer's claim settlement ratio. This applies to the insurance side of the product. The claim settlement ratio tells you what percentage of claims a company settled in a given year. IRDAI publishes this data annually for every life insurer in India. A higher ratio, consistently maintained across years, means the insurer processes claims reliably. For a product you are committing to for 15 or 20 years, this number matters. Do not buy on plan features alone. Check the insurer behind the plan. Let us go one level deeper on fund selection because this is the question that comes up most. How do you choose the right fund option in a ULIP? Your fund choice is not permanent. The whole point of the switch feature is to let you adjust allocation as your circumstances change. That said, your starting allocation matters. Here is a practical way to think about it. If you are under 35 and your goal is more than 15 years away, a higher equity allocation, say 70 to 80%, gives your corpus the growth runway it needs. Equity markets move up and down in the short term. Over 15 or 20 years, they have consistently grown for investors who stayed in. If you're between 35 and 45, a balanced allocation, roughly 50% equity and 50% debt, keeps growth going while adding some stability. If you're above 45 and your goal is 10 years away, start moving more of your money into debt funds gradually, maybe 10% every year or two. Think of it like this. You have spent 15 years growing your savings. The last thing you want is a bad market year wiping out a chunk of that. Right when you are close to the finish line. Debt funds will not grow as fast, but they hold their value far more steadily. Now, a key point on ULIP equity versus debt fund selection in India. Do not switch funds reactively based on market noise, and consider this your ULIP fund switching strategy for India. Switch for life stage rebalancing, not for market timing. Switching every time the market moves works against the compounding you are trying to build. Before you pick a fund, look at its past performance relative to its category and benchmark index. Past performance does not guarantee future returns, but a fund that has consistently beaten its benchmark over 5 or more years is telling you something about how it is managed. Before we wrap up, I want to quickly answer the 3 questions that come up most when people are evaluating a ULIP for the first time. How do I choose the right ULIP plan in India? Start with your goal. Then check the fund menu, the charge structure, and whether the lock-in period matches how long you actually plan to stay invested. Do not start with the premium amount. Which fund option should I choose in a ULIP? Match your fund allocation to your age and your goal timeline. Younger with a long horizon means higher equity. Closer to your goal means gradually shifting to debt. Use the switch feature for life stage rebalancing, not market timing. Is ULIP well suited for long-term investment in India? A ULIP is designed for goals of 10 years or more. The charge structure, lock-in, and fund flexibility are all built around that horizon. It combines life cover with market-linked investment in one product, which suits someone who wants both running in parallel. Whether it suits your specific situation depends on your goal, your timeline, and your risk comfort. An ABSLI advisor can help you map that clearly. If you want to see how ABSLI's ULIP offering maps to your specific situation, there is a link in the description to speak with an advisor. If this helped, like and subscribe. And if you want to go back to basics on ULIPs before applying this framework, we have linked a full explainer in the description.